Those people who want real leverage and a bit of speculative fun, well, that's where you go to the exploration end. There's nothing like gold that when you discover it, it's discovering money in the ground.
I'm very positive about the industry's ability to cut emissions, improve its performance, and improve governance overall.
There are ample studies now that show, and the World Gold Council did a good paper on this last year, that show allocations to gold can actually reduce the carbon footprint of a diversified portfolio.
So I'd like to welcome everyone today to the Gold Sector Opportunities webinar that is hosted by the Assay Live and One-to-One Group. So joining us today, we have Jordan Eliseo, Manager for Listed Products and Investment Research for the Gold Corporation, the Perth Mint. We have Warwick Grigor, Executive Chairman and Managing Director at Far East Capital. And we have Wayne Gordon, who will be joining us shortly, and he is Executive Director and Chief Investment Officer at UBS. Before we get into the topics, I'd just like to remind everyone in the audience that we will be taking questions throughout the course of the webinar. So please feel free to type them into the Q&A box. Not the chat box, but the Q&A box makes it a little bit easier for us to take the questions. So at any point, feel free to type in your questions and we will address them as we can. And so we have an hour for this webinar. We'll kind of see how long, see how many questions we get from the audience, and how much we're able to cover today. So to kick us off, 2021 saw gold prices settling from their 2020 highs, and investment was relatively understated. Now, some analysts are predicting that gold could rise significantly again in the coming year. So I wanted to start out just hearing our panelists' thoughts on the outlook for gold 2022. Where do you think we are going to go in terms of supply, demand, and pricing? So maybe Jordan, if you can kick us off there. Hi, Wayne. We are just starting off with a talk about the outlook for gold 2022. So Jordan's going to kick us off here.
Sure, thanks, Amy, and thank you for the invitation to participate. Look, my view is gold's relatively well placed this year. I think the correction that we saw for most of 2021 was actually pretty healthy. So obviously, the market had a huge run between roughly Q3 of 2018 and August, September of 2020. In US dollar terms, gold was up about 70% peak to trough in that period. And really what we've seen over the last, let's call it 15 odd months, is gold, kind of working off some of the excess froth that had built up in that time. And it's given up, roughly 15% of the gain now and trading around $1,800. So I think gold's, I think it's relatively well positioned for a number of reasons. One, it's worked off the froth. Two, it's had, just a 15-month time period now to consolidate those gains. And three, I think a lot of the, for want of a better expression, bad news that people have worried about regarding gold, most notably the end of QE and interest rate hikes expected by the Federal Reserve and other central banks, I think that's by and large priced in now. So the market has had time to digest that. It's had time to recalibrate pricing, not just for gold but for a range of asset classes. So I think on balance, gold is relatively well positioned, probably from an investment side. So one of the really encouraging things last year was that consumer demand was pretty reasonable for gold. The bit that was missing was investment demand in Western markets, most notably through ETFs. That's going to be one factor to keep a really close eye on this year.
And Warwick, what are you seeing?
Yeah, I think the gold market is very hard to pick. That's the first thing I'll say. Even after 40 years of involvement, I don't have a monopoly on where it's going. I think that the biggest influences on gold now at the moment, it's twofold. There's a geopolitical uncertainty offered by China and Russia. And there have been reports that those countries have been soaking up gold every time it starts to come below that $1,800. There seems to be support there that is confusing chartists and everyone else. So something's happening that we don't have total clarity on. But as far as inflation is concerned, it depends on which day of the week the news comes out as to how gold is going to react. It's not a consistent response. Inflation is supposed to be good for gold because it's a measure, you protect your value. But if interest rates go up, then the argument is, well, gold's going to come down because it's not an income earning asset. But if you consider that people who hold gold, there's very few people who just have gold and nothing else. It's a proportion of their portfolio. And as far as interest rates go at the moment, gold is always going to do well while you've got negative real interest rates. With inflation running at 5, 6 or 7%, but in the US, for example, interest rates are a long way below that. So that interest rate argument as to why gold prices should go down isn't working at the moment because interest rates are negative still. So I think that you've got other things like Bitcoin and more aggressive speculative assets that are said to have sucked money away from gold, but that's at the margin. The real gold holders that provide the depth of strength in the market are long-term holders that keep putting it away. So we shouldn't get confused by flippant short-term trading activity.
And Wayne, to bring you in here as well.
Hi, guys. I agree with Warwick. I think there's a tactical view on gold and there's a strategic view on gold. The tactical view on gold is that it's pretty difficult to be long gold in an environment where growth is actually, economic growth is performing very well. We have had some jitters in China in the second half of last year, and that seems to be continuing into this year. But generally speaking, China is now easing policy, and so that should shore up growth at least, and supporting Asia in particular. But most investors that are holding gold currently have been holding because inflation continues to surprise to the upside, as Warwick pointed out. And that has, even though real interest rates, if you look at 10-year real interest rates in the US, if you take the tips as a proxy for that, real interest rates have moved about 60 basis points higher, or being still negative, they're 60 basis points higher than where they were in the fourth quarter of last year. And usually when that happens, gold comes under pretty material pressure. But at the same time that's been happening, that's really disrupted a lot of these quite elevated valuations in a lot of the favoured stocks coming out of the pandemic, like the tech stocks and so forth. And because of that, we've seen a pickup in volatility in equity markets. And we know that there are, at least on a very tactical basis, there are three key drivers of gold. That is, as we spoke about, real rates, that is US dollar, as well as the fear in equity markets or uncertainty, because gold is an insurance asset. And that uncertainty picked up at the same time that real interest rates were rising. So in some ways, they sort of offset themselves for a while. But looking forward over the sort of once the Fed is fully priced, once market has settled around some number about quantitative tightening from the Fed, then the reasons for holding gold are likely to come under a little bit more scrutiny. And we think gold falls back to around the 1650 by the end of 22. But again, as Warwick said, we advocate for clients holding gold in a portfolio from a strategic standpoint. Our main point is you protect the downside to those holdings for now. Perhaps you don't add more gold to the portfolio, or if not, if you hold a lot of gold, you begin to trim that back. and then wait for another opportunity where economic growth slows further, and then people begin to get concerned about slowdowns, and then we'll start to see a more of a firmer footing for gold, whatever that number might be. Now, we think that's around the 1600 to 1650, but there will be a point where it is time to push the green light on buying gold again within an 18-month period, is our view.
Wayne, a question for me, if it's all right. Can you see that happening, coming back to those levels, without a stronger US dollar, or is a stronger US dollar part of that formula?
Yeah, that's a really good question, Warwick, and it is. And to be completely transparent, our view on the US dollar versus the euro, particularly, where a lot of the broad dollar movements come from. We have a 110 on the US dollar euro by the time we get into the second half of this year. So it's that combination, I think, that you're referring to that bring gold to those sort of levels. Of course, that including the equity market sort of begins to find a bit of a level of stability, and people start to feel a bit more confident that valuations have readjusted to the new view on the cost of funding and so on. Yeah.
So gold, as you've mentioned, has always kind of held this position as a safe haven investment. Do you think that gold will continue with this in this state, with this idea around it?
I'm happy
do you
to
want?
you go, Wayne.
No, well, I was just going to say, Amy, we actually, look, there's been a lot of talk about, and I'm sorry to send this down a rabbit hole, and please grab the rabbit and bring it back out again if you need to. But we've been asked a lot by clients over recent times, is Bitcoin the new digital gold, right? And I think this event that we've seen recently, where Bitcoin is it halved or more than halved in a very short period of time, really amplifies the view, or at least our view, that these things are different assets and you shouldn't consider them as like on like. When we looked at this from a portfolio perspective, what we found was that digital assets, it wasn't just Bitcoin, but other variations of it, we found that it doesn't actually materially add to the diversification of a portfolio. Absolutely, returns are good when Bitcoin is rising, and it does provide additional total return to a portfolio. But as we've seen recently, the volatility aspects of Bitcoin, the fact that it is not fully fungible across all assets, which, gold, clearly, in many places, you can buy all manner of things with gold. And you need that network, you need that sort of digital network to support those digital assets. So there's a lot of elements of gold which speak for it, and particularly recently speak for it as still the ultimate safe haven or the ultimate insurance asset in a portfolio. Now, look, that might change over time as Bitcoin and other digital assets become more fungible and they begin to get used more in day-to-day trade. And I'm not suggesting that gold can be used in the day-to-day exchange of goods. We don't go to the supermarket and use gold to buy milk, for example. But what we have seen recently in the research that we've done has really amplified our view that, at least in the foreseeable future, gold is the ultimate insurance asset in this context, alongside of many other things such as US Treasuries, for example, and so on. But we still think that gold holds that place. Yeah. So you can pull the rabbit back out of the hole now if everybody doesn't want to have a discussion about Bitcoin as well. That's okay.
Well, I mean,
I just going to say, as an analyst, we've had the discussion on Bitcoin many times with clients, but it's impossible to come up with a valuation. And how do you decide whether Bitcoin is worth this amount or that amount? It's all based on psychology, and the volatility and the gambling aspect is what people want. But I don't believe that people who buy gold are as fixated on gambling as Bitcoin players. So they're coming from a completely different mindset.
Yeah, completely agree with that, Warwick. Yep.
Yeah, I'm actually very, very comfortable with this rabbit hole. I like it, so I'm happy to stay here for a while if everyone else is. But yeah, look, I've written on, I suppose, the merits and comparisons between gold and Bitcoin on a handful of occasions over the last few years, and you know, my view on it has always been, look, Bitcoin is great if you want a speculative asset and you're happy to take the risk of losing a substantial amount of your capital in the hope of, you know, making 3x, 5x, 10x. But it clearly isn't the safe haven that gold is. It hasn't exhibited, you know, a negative correlation to equities when they fall. It hasn't exhibited over the long run, you know, strong price growth in sustained high inflation environments. And when you sort of think about what, you know, when we say a safe haven, what you typically want a safe haven to do, you want it to balance out your portfolio in environments where equities are stressed or in environments where consumer prices are rising for a sustained period. So that's not a knock on Bitcoin per se. It's just to Warwick and Wayne's points. It's not a safe haven in the way gold is or in the way markets traditionally look for a safe haven. I think the other thing that's really interesting about Bitcoin and crypto assets more generally is that some of the, you know, very much eye-watering price growth that they delivered them from a starting base of almost zero, right? So if you get the most speculative, you know, company listed on a stock exchange, it only needs a tiny amount of money to go into it in order for its price to double, triple, or go up 10x. That's a very different investment proposition to a blue chip with $1 trillion market capitalization, for example. And so, you know, a lot of people will look at Bitcoin and go, wow, this thing's gone up 200% annualized for 10 years. And it's like, yeah, but that's because when it started, it had a market cap of zero, right? So for Bitcoin to double now, it needs, and this is before the recent correction, so kind of using the end of last year's figures, it now needs to increase in market value by almost another $1 trillion, right? It needs real money to come in now in order for it to deliver anywhere near, or indeed even a fraction of the returns that it delivered in the past, with only tiny slivers of capital being allocated to it. And that's why I think, you know, when people look at, and Warwick made this point, saying, you know, people like to talk about Bitcoin being digital gold, but really when people allocate to crypto, they want big returns and they want them quickly. Crypto and Bitcoin specifically, it has delivered that in the past, but it's almost mathematically impossible for it to continue delivering it into the future because the market just cannot keep growing at the rate that it did.
Yeah, the Bitcoin's vulnerable to a new toy coming along next week, but gold's not. Gold has survived the test of time. One day, these Bitcoin style assets, they'll move aside for something else.
Yeah, I think that's. Sorry, Wayne, were you going to?
No, go ahead.
I was going to say, I think that's a good point as well. There are things you can track. One's called like the Bitcoin Dominance Index, which looks at what share of the crypto market is actually made up of Bitcoin versus other cryptocurrency other cryptocurrencies, and that number has been falling fairly seriously for most of the last 3 or 4 years. So actually, you know, if the market is telling us anything, it's that as cryptos evolve, and let's assume that they are going to stay and be part of the financial system going forward, it's actually telling us that the kind of, for want of a better term, monetary use of crypto is becoming less important and less significant as a segment of the overall crypto market share. So, yeah, I think that, you know, it's actually possible to be bullish or at least curious on crypto and at the same time be highly skeptical of Bitcoin, and very, very clear that it's a different asset to gold in terms of its role in a portfolio.
Yeah, we've got, correct me if my terminology is wrong, but these NFTs, non-fungible tokens, that's taking the whole concept of Bitcoin one step further into something that's got absolutely no value except what someone else is prepared to pay for it. And it's a social trend. There's obviously a certain amount of manipulation, but in my book, there's no way I would be buying something that didn't have some fundamental value underneath it. But it's a symptom of too much speculative money in the market, and people are prepared to gamble. And that goes back to all the credit creation that we've had over the years. We would normally be expecting all that credit creation would be going into gold. But these new products coming along that have got no link to reality tend to be muddying the water somewhat.
So, I mean, that kind of crosses off my next question, which was kind of looking at this competition from Bitcoin. Why do you think this conversation has come up, kind of directly correlating gold versus Bitcoin?
Well, I think it's natural for a handful of reasons. First and foremost, Bitcoin is heavily promoted as digital gold, right? So its biggest advocates, for want of a better term, market it as a hard currency, market it as an alternative to gold, market it as gold 2.0. So, when, an asset is presented to the market in that way, and when the asset has the astronomical price growth that it has, and to be fair, also some pretty interesting developments along the way. Last year, Tesla, added Bitcoin to its balance sheet for a while, etc. It's kind of natural that the conversation about Bitcoin and gold is going to grow. And it's probably also fair to say, if you think about it, I'm talking in US dollar terms alone here, Bitcoin's really been around for the better part of 10 years. Actually, that 10-year period has been pretty underwhelming for gold as a whole, right? Gold hit the better part of $1,900 US an ounce for the first time in 2011. 10 years later, we're still here, right? So we've had a 10-year period where in US dollar terms, gold has basically treaded water, had a correction and then got it all back, whilst this, to Warwick's point, shiny new toy has been delivered to the market, is being advertised as a competitor, and has had this phenomenal price growth off of a standing start. So I think it's whilst I think we're all agreed here that Bitcoin is not necessarily gold 2.0 and very different roles in a portfolio, it's not entirely surprising that the discussion is taking place.
Well, those people who are trying to compare gold and Bitcoin and saying one's old, one's new, and it's going to replace the other, I think that shows a fundamental misunderstanding of what gold has been over the centuries, over history. And the Bitcoin players are using marketing and psychology to try and impart some sort of credibility or solidness to Bitcoins, which isn't there except for the manipulation of perceptions. I think it's all very deceitful.
We've had a question from the audience asking, with its extreme volatility, how can Bitcoin be viewed as a stable store of value? Or I suppose, can it be seen as a stable store of value?
It can't. Simple as that. It can't be. Only by deluded people.
I guess from a point of view of resource scarcity, I guess that is probably something that I don't think we've quite discussed, but obviously Bitcoin has a emerging scarcity value, if that's how you want to sort of talk about it. And I think that's how that correlation sort of begins, is that, there is a resource, gold is a mined resource, and, there is only so much gold in the world, and so it has a scarcity sort of value in that context. And Bitcoin is viewed in a sort of similar way. And I think maybe that's where the conversation starts, and then it sort of extends out to, well, maybe it could be a diversification asset, and maybe it does perform better during periods of high inflation relative to gold, because gold's performance during periods of inflation or inflationary periods, gold's performance has been quite mixed. It did very well at certain periods, and at other points it hasn't. And I think this is last year where this discussion sort of began to manifest itself a little bit, Amy. And as I said before, the first couple of months of this year have certainly dispelled some of those views. As you know, as markets have come under significant pressure, Bitcoin has come under significant pressure, yet inflation's continued to surprise, and gold, against all challenges, particularly from the rate side, has held pretty solidly. So I think, you know, it's as everybody has discussed here, as Jordan and Warwick have both discussed, it's an evolving debate that will return at some point, but at least at this point, some of those myths have been dispelled, particularly around the performance of Bitcoin in an inflationary environment, at least. Yeah.
I mean, it leads kind of into an interesting discussion about the ESG factors relating to investment and holding these commodities, you know, gold versus Bitcoin, and I suppose the green aspects of mining gold, mining Bitcoin. I'm not sure if anyone wants to comment on kind of those ESG related topics.
Well, I find it interesting that you never get any mention of how much carbon emissions Bitcoin mining is actually responsible for. It's conveniently avoided, but from my understanding, it consumes an awful lot of electricity, and where that electricity comes from will determine the green aspects. But it's, you know, you come back to industry that has carbon emissions. They're doing things. It comes with industry. What does Bitcoin give us that justifies spending so much money on electricity that we actually need?
I think that's a good point, Warwick. And I think ultimately the ESG debate around, well, if we focus it on gold first, you know, yes, there are obviously emissions involved in, you know, mining, refining, transporting gold, but the industry has really made you know, very large steps in terms of controlling that and getting on top of that. Two, you know, there are ample studies now that show, and the World Gold Council did a good paper on this last year, that show allocations to gold can actually reduce the carbon footprint of a diversified portfolio, because you're obviously taking some money out of, you know, predominantly equities and fixed income assets. And if you rotate some of that money into gold, all other things being equal, actually the carbon footprint of your portfolio is likely to decline. And part of that is because, you know, gold's 100% recyclable asset. There's a lot of it that actually is just sitting in vaults, you name it. So I think gold definitely ticks the box from an ESG perspective. With Bitcoin, it's certainly far more of a question mark. So I'm working on a new paper on this, and ESG is one factor we're looking at. And I think the estimates are now that if, you know, Bitcoin was a standalone country, it would rank as number 39 for overall electricity usage, you know, which is extraordinary. But ultimately, I guess that, you know, the view of Bitcoiners would be, you know, this hard currency, which is what they market it as, is, you know, the key to a more, you know, sustainable and fairer financial system. So, you know, if that's what it's going to build, then the carbon emissions are worth it. Most people don't think that's what Bitcoin is, though. Most people think Bitcoin's a speculative vehicle, and if so, it's probably the most energy-intensive form of gambling that humans have ever created. And I think, you know, ultimately, you need a view on what Bitcoin, the asset, is before you have a view on the ESG bit. But what I will say is that, you know, particularly for institutional investors, my gut feel is that ESG thing is going to be a very big barrier for them to allocate capital to Bitcoin, because institutional investors are not buying Bitcoin because they want to use it to be able to go and, you know, buy cups of coffee at the local coffee shop. They're buying Bitcoin purely as an investment asset, and the ESG factor is going to be one of the screens that it needs to get run through. And I think right now it probably fails, or there's at least a big question mark over it from that perspective. I don't know, Wayne, whether you have a different view, a house view, or just a different perspective.
Yeah, I think so. The way we take it pretty seriously, particularly from our clients who own gold. You know, we, for example, offer what we call green gold, as an example, where there is a premium to that for a whole bunch of reasons, such as certification and so on. But when I look at the mining companies themselves, most mining companies are doing an extraordinary level of work to make their processes, their governance, the way in which they interact with local communities and so forth. They're making extreme effort to try and improve the overall processes or the supply chain. And I think in particular, the governance aspect, I think is, we talk about the use of electricity, but of course, the governance aspect as well is an issue with respect to a number of digital assets. It's and so I think the industry as a whole, particularly, well, in respect to the gold industry, I think they're doing an extraordinary amount. We have a long way to go, but the actions are there. And particularly when we talk to companies now, at least the extraction side, they are on the front foot with most of these initiatives right at the get-go. This is the centerpiece of their results presentations, and particularly with their resourcing. What I've noticed is in the last couple of years, a great deal of resources and responsibility has been placed into these areas, and I think that will have great outcomes going forward. And I'm very optimistic about that. And the inquiry from the client side has risen materially as well. So we basically had to push and to pull through the system. So I actually think there's some really exciting things happening there, Amy. I'm very positive about the industry's ability to cut emissions, improve its performance, and improve governance overall. And I think that's a really exciting part to focus on. Yep.
I think actually as well, there's a link there between the sort of the ESG factors, which I think definitely favour gold over Bitcoin at this point, and more broadly sort of governance and regulation around the two industries as a whole. So, you know, if you look at gold, it's an incredibly deep liquid market. You know, the major market makers and custodians are, you know, they're central banks or they're major, you know, listed financial institutions that have oversight, governance, regulators that they answer to and engage with. And that gives investors confidence that, you know, that the asset trades in a market that they can feel very, very comfortable with. If you compare that to crypto assets, and again, this is not a slight per se, it's just the fact that it's such a new asset class. There are still major question marks around the governance around some of the stable coins that a lot of crypto assets are traded in. There's huge question marks around the actual liquidity in some of these markets. And indeed, you know, if you look at the United States, my understanding is that the SEC is still yet to allow the listing of a spot-based Bitcoin ETF for the very reason that they still have question marks regarding the underlying ecosystem that you know, effectively Bitcoin trades through. And so I think, again, that's another, you know, I think ESG is, for want of a better term, you know, can be wrapped up with broader kind of governance and regulation concerns that in particular institutional investors will have. And when they're assessing these two asset classes on those merits, again, gold you know, is head and shoulders ahead of crypto at this point.
There's one point that isn't often mentioned nowadays about gold, just getting off Bitcoin for a minute. One of the theoretical and practical arguments why gold is good in times of inflation, which we're coming into now, is you can't debase gold due to the limited supply. Almost every ounce of gold that's ever been mined is still on the surface in some use and can be recycled, but incremental gold production each year is somewhere in the range of 1 to 3% increase. It used to be, I'm assuming that those numbers are still correct. So if inflation is linked to the rate of increase of money supply, be it in 1, 2 or 3 or whatever, you can get all money supply increasing by 10 or 20% in inflationary times. And that erodes the value of that currency significantly. The reason why you hold gold is because you're not going to debase that store of gold by more than 1 or 3% per annum, which is always going to be less than 5, 10 or 15% inflation, which has happened in my lifetime. And that's a point that doesn't get mentioned much anymore, but it's worth remembering.
We had a question come in from the audience, keeping in line with kind of the ESG idea, asking, do you think the gold mining industry will embrace full value chain tracking like the diamond industry has?
That's a bit harder, Jordan, with your experience with the mint. Once you've got 99.99% purity of gold, can you trace where that gold has come from chemically? You can if it's doré from a mine site, but once it gets to be an investment grade gold, can you still trace the source of it with something like the Kimberley process?
Yeah, so I don't think there's a direct comparison necessarily with what's happening in the diamond space. And I've also got to, acknowledge up front that, my role with the mint, I deal with the end investors that buy the products, as it were, rather than on the refining and logistics side of bringing, doré or scrap metal into the refinery in the first place. But certainly, I can speak a little bit about what the mint has done, in the sense that there's been 2 or 3 major initiatives over the last couple of years around governance and of the supply chain. As for whether or not, though, it's ever going to replicate what the diamond industry has done, I don't think the gold industry is in a position to do that. But there'd be better people to speak on that subject than me, to be honest.
So I guess to move on, we have had quite a few questions from the audience that were asking about specific companies and their outlook. And what we'd like to do is try to kind of stay away from providing direct investment advice, but it might be interesting to hear the panelists that are active in this space speak a bit about the criteria that you use to assess investments in the gold space. You can bring in the ESG concerns, but also kind of everything else that you use to assess companies and potential investments. Maybe Warwick, if you want to kick us off there.
Yeah, I think that gold producers are one kettle of fish. You will look at production schedules, you'll look at forecast guidance, opportunities for cost reductions. You look at all those fundamental aspects of operations as you're trying to decide which gold producers you want. In the past, in my 40-year history as a gold analyst, I've been described as a gold bug from time to time, but that's very incorrect. I look at investments in gold companies more for their growth potential and earnings potential. Once you're actually an established, mature producer, you've got different considerations, and that's where corporate activity comes into it. And that's a whole different ball game. You get egos involved. It's very different. Whenever I'm talking to clients about buying into gold, I'll always be looking at a company that's got expansion coming through. It might be a developer of gold that's turning what is ground that might be worth $5 or $10 an acre as desert suddenly becoming worth millions of dollars an acre because of the gold that you find under that soil. I think that you need to decide whether you just want the stability of the gold price and you want the liquidity of very large, highly traded stocks like Newcrest or Evolution or things like that, or whether you want to factor in growth through expansion, which brings in a whole lot of different set of risks. And commissioning risks is one point. A lot of companies that are becoming gold producers for the first time they make mistakes. And it is a riskier time to buy shares in a gold company as it starts to finance and develop a project than a year after it's been operating. And those people who want real leverage and a bit of speculative fun, well, that's where you go to the exploration end. And there's nothing like gold that when you discover it, it's discovering money in the ground. You don't have all the issues of can you sell it? Who's going to be the buyer? Do you have to deal with third parties to turn it into cash? So whenever I'm talking to investors on gold, you've really got to find out what their risk tolerances and preferences are. And, each one involves a lot of specialist consideration. But one thing I will say on a global level, I have noticed over the last 6 to 12 months that gold stocks in Canada, not looking at the big producers as much, but the medium size and developers and explorers, the Canadians of half the price or even less than that in terms of, or greater discount than what the Australian stocks are. In Australia, it's almost like anywhere you put a drill hole down in West Australia, you'll find gold. Now, how much it is and whether it's going to be an economic proposition is another thing, but there's probably no jurisdiction in the world which is as good at providing joy for investors as West Australia at the moment.
Yeah, maybe just from our side. So when we look at the gold sector, the first thing that we think about is the price dynamics. Now, the gold sector per se is highly correlated to the movements in the gold price. It's probably not that dissimilar actually to mining and materials more generally, but it does have that very high correlation to the underlying, and it trades at higher volatility to the underlying. So as an investor in gold stocks, whether it be at the index level or the individual company level, you have to remember this. And that's pretty key at the moment, because when you look across the board at mining and materials, gold stocks probably offer some of the best value from a mining and materials perspective within that sort of portfolio. And not only that, but also look, a number of gold producers are not pure gold plays. They, have other materials that they're looking at, such as copper and lithium and so forth. And so you also need to think about how the general, I suppose, the suite of metals in which they're producing, how that's contributing overall to the company's revenue streams. So that's a couple of key considerations. At the moment, as I look across all the big gold names that I look at, I'm not positive right now just because I have a negative view on the gold price. So it's not that I don't see the value. It's not that I don't see that they're discounted relative to, other mining and materials. It's just, I think that we're at the wrong part of the cycle, the way in which the gold price will trend over the next 12 to 18 months to be picking these names up. Now, as I said in my beginning, that's not to say that in 18 months' time we don't have a situation where we become a bit more neutral on gold, and then some of these companies offer enormous value to the upside. But when we think about the cost of production, probably the 80% cost of production, you correct me if I'm wrong, Warwick, but it's probably around the 1,200, 1,300 an ounce would be the upper end, I suppose, across the spectrum. So the free cash flow of these businesses is enormous. It's just that this historical relationship to the price, when the gold price sells off, gold equities tend to sell off with it. Similarly for people who produce silver, for example, silver prices also linked to gold prices tend to come down. So that's really my reluctance tactically, but strategically from a mining materials perspective, probably some of the best value in the mining materials sector sits in the gold sector currently as we speak. Yeah.
Yeah, on that price of $1,200 to $1,300 an ounce, that's what on first glance the industry looks like. But I've had suggestions put to me in recent months that it's actually at least a couple $100 higher than that if you dig deep.
Yeah, that's interesting, Warwick.
Yeah. So that was put to me a couple of weeks ago by someone who does dig deep.
Interesting. Yep.
It's worth mentioning that the supply and demand analysis for gold doesn't work in the same way as it does for other metals. What you can produce, you can sell. And the market is very deep. There's no one project which is going to move the market. Whereas a lot of these specialty metals, you can find there might be 10 or 20 mines in the world, and a new project can shift the curves. But gold is much deeper than that, and there's much less likelihood of disruptions to the gold price from operations, new or expanding.
Okay. It's interesting. So I suppose, we're coming up to the hour mark. And so I think just to wind things down, it might be interesting to hear just our panelists' thoughts on, what we can expect in the next 12 months. I know you don't have crystal balls, but what do you think people can be looking out for in the gold markets coming up?
Maybe I'll kick off, Amy. Obviously, I've put my forecasts out there. We expect the 1650 in 12 months. We have a stronger dollar view as a house. We see real rates continuing to move higher in the US, and we think that inevitably, valuations in equity markets will somehow come about to some sort of equilibrium with all these changes in expectations for the costs of capital and so on. So that's why we have a fairly tough view for gold over the next 12 months, I would say. The thing for me is the key turning points for me are twofold. Firstly, when inflation does begin to come under pressure at a global level, so we have seen, these supply chain disruptions, etc., really driving inflation. The US with a 6-7 handle on it. So when inflation peaks, I think that's a key trigger point for gold coming under more evident pressure, and also where earnings and valuations and so forth end up on other assets, and when we think the Fed is fully priced, because the way yield curves are behaving, it feels like we're moving into late cycle in the economic cycle per se, and we've just come off of one of the longest cycles. COVID disrupted one of the longest cycles we've had in recent memory. This would be one of the shorter cycles we've had in that context. So while it might feel a bit painful in gold for the next 12 to 18 months, the prospects of the very short hiking cycles of central banks also brings about into view, gold may be back in favor more quickly as well. So I think investors need to be mindful of that, be careful in the short term, but be more strategically positive for gold as we look forward over a 5-year basis.
Jordan, any last thoughts?
Yeah, look, I think I certainly sympathise with the view that there's headwinds for gold in the short term, and seeing it drop down to that sort of $1,650, $1,700 range, really wouldn't surprise in the slightest. I think I suppose I'd make a couple of points. One, if you think in terms of percentage returns, that's only in US dollar terms, it's only about an 8% pullback from where we are now. Certainly down here in Australia, the environment where gold moves to 1650 US is probably an environment where the Aussie dollar falls back below 70. So the decline for local investors would be even less than 8%. So I think that if people are, longer term allocators, and most of our clients are, they're starting to get encouraged with what they're seeing with gold now and are starting to buy now. And I think actually, if you look at what happened in January in North America, we started to see some money come back into gold ETFs as well. So that suggests that, allocators are now starting to, just dip their toe back in on the long side. They're not getting too aggressive. I suppose in terms of the outlook, and I'm not one to put a price prediction out there. The only, I suppose, points I'd make, and I agree with the comments around inflation and interest rates. As I say, the counterpoint is that by and large markets have now priced some rate hikes in. And even with the inflation front, I mean, one of the things that I think has been fascinating this, last year and in this year, is that if you look at sort of 5 and 10 year break-even rates, especially 10-year rates, they never really got anywhere much past sort of 2.5%, 2.75%. And right now they're back down to about 2.4%. So the way I look at it, the market is kind of already expecting inflation to dissipate and fall away going forward. So I think even if that happens, that might not be as big a tail or as big a headwind for gold as you might otherwise expect. So yeah, I can certainly see the bearish case, but I think, more importantly, the main bit that I definitely just agree with Wayne on is that strategically gold looks, it looks like an asset you want to own, and it can play an important role in a portfolio.
Great. And Mark, final thoughts?
Yeah, well, I've always found the best indicator of where the gold price is going is where it's come from recently, and because of the compounding effect of psychology and market expectations. And it is very difficult to see more than 3 months out because the psychology can change rapidly over that 3 months. But I'm more inclined to say we're just going to see more of the same for the time being. I don't expect it to get below 1700. I think that 1750 to 1850 is where everyone's comfortable with at the moment. And so they're working within that range. But at any time, something could come out of left field. But the risk is that it's something that will drive the price a lot higher, not lower. And that would be geopolitical conflict, something horribly going wrong. And so there will be a rush to get more gold. I see that as more likely than a heavy crunch down. The markets have tried to crunch down, and you've got to appreciate that the traders make money out of volatility, and they'll test on the short side and on the upside to see how much they can move the markets once they've got set, and they'll do a campaign. You might call that manipulating the markets, and it is to some extent, but that's the way traders operate. If they push it one way and they get pushback, they'll try the other way because they don't make money out of a market that is flatlining. It's got to have volatility. So I don't see anything dramatic.
All right. Well, very interesting conversation today. Some good rabbit holes. So thank you to all of our panelists for taking part today. It was quite interesting. Thanks to the audience for providing your questions. We will be distributing the replay link shortly if you want to have another listen through. And this session will also be included in the upcoming gold edition of the assay. So stay tuned for that at the end of the month. So thank you again to everyone for taking part today, and we hope to see you again soon.
Thanks, Amy.
Thank you, Amy.